the Alt Asset Allocation Podcast, exploring alternative investment opportunities available to the everyday investor. Here's your host, Ben Lakoff.
Hello and welcome to the Alt Asset Allocation Podcast. Today's interview is with Wyatt Cavalier on all things alternative assets. If you've listened to this podcast much, you've realized that alternative investments likely deserve a spot in nearly all investors' portfolios. Wyatt runs alts.co, and they've recently launched a fund dedicated to sniffing out these alternative investments. I obviously love alternative investments. Collectibles, crypto, wine, whiskey, art, sneakers, music rights. There's a lot of capital sloshing around these alternatives, and I just love digging into them, and this conversation with Wyatt does just that. Before you listen, please don't forget to like or subscribe to the podcast, or even better, leave a review. If you're watching this on YouTube, give it a like, maybe a subscribe, share it with a friend. All of these things help spread the word about the channel. I really, really appreciate it. Enjoy this conversation with Wyatt on the current state of the alternative asset market outside of just crypto. Enjoy. Wyatt, welcome to the Alt Asset Allocation Podcast. Excited to have you on today.
Yep, happy to be here. Thank you.
Yeah, one, big fan of your URL, alts.co. Very nicely done. But also massive fan of alternative assets overall. Very excited to get into all things alternative assets. But to start off, let's go a little bit intro onto you and what led you to getting involved with alternative investments.
Yeah, I think like a lot of folks in this space, I've come from a pretty varied background, and yet no one has really been in the space for more than a couple of years as anything more than sort of like a hobby, because it's so new. Now, there are people who've been, coin collecting for 40 years or whatever it is, but in terms of treating this as an institutional investment sort of opportunity, it's pretty new. My background is I was with the Army for a while. I did intelligence analysis for a while, sort of with the government, and as an Army officer, I've done banking, I've done finance. I was an entrepreneur for 9 or 10 years. I sold fair trade coffee to offices and cafes most recently. And that, of course, did really well with COVID. So COVID gave me the blessing of an opportunity to spend 18 months or so without very much to do, because obviously like all the offices were closed and cafes were closed. And that's when, I dug into what do I think is going to make a difference in the world in the next 30 or 40 years I've got still on the planet, and how can I be a part of that? And closing the wealth and income gaps sort of came out to me as something that's more and more important. And even like wherever you are on the income and wealth spectrum, it's important to close the gap, because if you're a rich guy but there's no one around to buy your stuff, then you're going to stop being so rich. And obviously, if you're poor, that sucks. So I started looking at that and how to sort of affect that change in an interesting and meaningful way. And fractional investing became sort of really clear to me as a great way for folks to accumulate wealth in the way that they'll actually do it. And most fractional investing, outside of stocks and bonds and things like that, is in kind of the collectible, whether it's, $5 million baseball cards split up into 500,000 shares, or rare books, or even farmland and things like that. It's a great way to begin to accumulate wealth. And there are a lot of platforms out there that made it easy. So that's how I kind of got into space.
Nice. And fractionalization, I feel like, is this big thing in crypto. People act like it hasn't been done in other asset classes before. I've been a fan of Fundrise and some of these other like fractionalization of real estate or art, but good to know that it's being applied in other asset classes as well. I'm curious, you're thinking about alternative investments for the average investor. Let's start just by defining alternative assets in your mind.
So I think it's anything that is out. So alternative is whatever is outside the scope of what most people think of. And most people think of first stocks and bonds, and then if they're a bit more adventurous or wealthy or whatever it is, it's hedge funds or venture capital or maybe a bit of gold, or they've dipped their toes into crypto and things like that. And so we're everything that's kind of beyond that. So whether it's things like sports cards, comic books, video games, signed bits of Apollo 11, collectible toys, action figures, like 78 Star Wars stuff, all the way to art, to vacation rentals, music royalties, wine, whiskey, sneakers, like rare books, like all that kind of stuff is what falls into sort of our purview. Most of it is non-cash generating. So unlike a company or a vacation home, most of this stuff isn't going to throw off cash. It's more based on accumulation and appreciation. Although you can try to put some cash behind some of it. So like music royalties fall into the space as well. And their whole point is the cash flow.
Gotcha. And I mean, how do you think about just easy money pumped into the system, kind of a rising tide lifts all boats? Perhaps these things are just pumped, inflated assets because of the easy monetary policies that we've had, liquidity premiums. How do you think through this sort of thing when thinking about these different asset classes?
So I think of it a bit in the same way that I think about like solar subsidies. So, solar is the way forward. It's important. It's only going to happen, or only has happened, in countries where it's been subsidized. I mean, by the time you subsidize it enough, the thing gets cheap enough, and it's a bit of a flywheel. So this space has been a bit like that, where the COVID stimulus checks came in 2020. People were sat around, didn't have a great deal to do, and they started buying baseball cards or shares of the U.S. Constitution or whatever it was. And what that's done is, there's a bit of lots of money being pumped in that wouldn't otherwise be there, but it also has served to normalize the space a bit and made it a bit more tangible and less scary. So, like most folks, their investment portfolio should be anywhere from like 5 to 15% alternative assets, and whether you want to call that hedge funds or wine or rare books, like it should be something in those spaces. And the median allocation to alts right now is still basically zero. So it was a bit unnatural, but I think it's been a good thing. And anything that gets more eyeballs in this space is good. And there's still literally trillions of dollars left that can flow into the space before it becomes oversaturated from an allocation point of view.
Yeah, so 5 to 15% is kind of like a good thumb in the wind estimated allocation to alternatives. Does that include things like gold or real estate, or you're saying like collectibles and these more like esoteric alternatives?
Yeah, I mean, I personally I kind of hate gold, but anything that's not correlated to the broader market. So it could be any of those things. It could be real estate. It could be art. It could be, buying a domain or a website that throws off cash. So the point of it is to, number one, it boosts your overall returns because this kind of stuff, at least for now, is less efficient, and so the returns are better. But also by building this in your portfolio, you reduce the correlation to equities and the overall market. So the more diversification you have, the less correlation you've got between your asset classes, the more likely you are to ride out bear, do even better in bull runs.
I agree with you. I oscillate between gold as this barbaric relic and, the whole fiat monetary system is going to collapse. I want some of it and kind of everywhere in between on a near daily basis. When thinking about alternatives, I mean, the average consumer or the average investor, presumably getting started and getting exposure to these asset classes is a bit of a challenge in that, like, it's the same thing with NFTs. When people say, hey, I know I want some NFTs, but I go to OpenSea and I get confused and I have no idea what to buy. It's probably about the same thing. Like, okay, I want a domain, I want a collectible, I want sports cars. Like, the breadth of options are pretty broad. How, like, I know that alts.co, you did a lot of reviews of a bunch of different websites. What are kind of the top websites that the average investor should know about to get better, more broad exposure to alternative assets?
Yeah, the best answer is ours, of course. So we do lots and lots of sort of like long form stuff about different asset classes, whether it's how to invest in Formula One or investing in billboards or private islands or wine or like any of this stuff. So that's a good start. And what you've got to sort of like worry about a bit is if you just Google like how to invest in X, the top 30 results in Google are going to be folks trying to sell you a course in investing or sell you something you don't want. So like I would always start with us because like I like us and we're decent at it, I think. But once you move beyond that and you find kind of like a niche that you're into, you just got to be really careful that what you're looking at, check what their motivations are, what they want from you. If you're looking for asset discovery, a lot of the fractional platforms are a great place to start. The kind of like, I think the biggest one in this sort of space is Rally, and they focus on all kinds of things. They started out doing classic cards, but now they do sports cards to books to NFTs to. I think they're actually bringing out a bit of gold later on this year, which is, I guess, it comes full circle. But then there are niche ones as well. So if you're into sports cards, Collectible and Dibs are great. If you're into art, Masterworks is great. And the key with all these things is find your niche, find out what you're passionate about, and then try to find a way to become dispassionate when you're making the investments. But it's so easy to say, like for me, for example, I think Cristiano Ronaldo, the soccer player, is a horrible person, but terrible human being. But doesn't mean I don't think his rookie card is a bad investment. You've got to be able to make that distinction. So finding someone or finding the ability to help you put an analytic framework behind it is super helpful. And that's something we do, and that's how we approach our newsletters and the fund we're launching as well.
And let's talk about institutional investment or allocations to alternative assets and then more niche alternative assets like collectibles. Do you have much information on that?
Yeah, there's not very much of that at all. So you've got Grayscale in the crypto space, and they're quite big. There's a company called Alts that does a fund, and they must have some institutional capital behind them. There's another Alts fund called Hedonova, and they've got some institutional money behind them, I'm sure. And there's our fund, and we've got a bit of institutional money behind us. But yeah, it's very, very early days, and the problem with anything like this is going to be distribution. How do you get this kind of asset class in front of wealth managers, investment advisors, the trading desk at Goldman or whatever it is, and do it in a way that someone sees it and doesn't think they'll get fired for it, basically, right? Like the downside of proposing new stuff is often a lot bigger than the potential upside. So that's where the stimulus checks and bringing folks into this space in a bigger way has helped, because it can come from the bottom up. You'll see individuals who work on those desks or work in that space, and they'll get into it themselves, and they'll realize, hey, this is actually a legit thing, and I can take this to my clients. And they just need a platform to help deliver that. And that's coming. That's evolving. The whole space is evolving rapidly.
Talking about access and education, if you could snap your fingers and change one thing to kind of get people over the line in terms of access and education to alternative investments, what would you do and why?
I think like any sort of emerging asset class, there's just lots of scams out there. So, there's all kinds of disreputable people out there who are kind of preying on that lack of education. And, it's easy, you see it in NFTs all the time, but even there's a bit of a mini scandal last year about video games where one of the two biggest grading bodies was alleged to have colluded with the biggest auction house to sort of pump and dump the entire asset class. And, whether or not it's true, it doesn't look good, right? So, kind of getting the asset classes beyond the frontier market space and into more well-regulated, more not risk averse, but just risk aware is only going to be good for the market. And there are more returns to be made when you're in the frontier space if you know what you're doing, but it's also easier to get stung. So, and that's where we've tried to help folks by pointing out what we think are scams, by pointing out where we think the good investments are. And we're not always right, but I like to think that we've helped with that, and hopefully we'll help move the dial.
Yeah, when deploying capital in alternatives, what is your biggest concern when initiating that investment? Is it something like liquidity, or is there a greater concern?
Yeah, it depends a lot on the asset class. So, for example, if you're deploying $1 million US into Bitcoin, that's very easy, right? So you can put it in and get it out in 5 or 10 minutes. The concerns there are, who's the custodian? What's the other side like? Is there counterparty risk? That kind of stuff. If you're looking at art, you got to make sure it's not a forgery. The fees are quite high in a lot of these spaces. Art's a good example of that. So if you're buying through an auction house, the fees are 20 to 50%, and that's a huge factor. And so how you source it becomes really important. If you're looking to put that kind of money into rare books, liquidity is a huge problem. How many people out there can spend or want to spend $500,000 or $1 million on a rare book? The market there doesn't really sustain that in a very liquid way. Unlike e.g. sports cards, where you're gonna take a haircut if you take your Mickey Mantle rookie card to an auction, but it'll be gone within a month, guaranteed. So every asset class has different concerns, and that's part of what we do. Is we look at that, we understand that, and you got to be mega aware of it. And if you don't know what you're doing with it, then it might be better to sort of give your money to someone else to manage and not have to worry about it.
Yeah, something within crypto we always hear is about the greater fool theory. Is that the biggest criticism of investing in some of these things? Is just, they're not cash flow producing. I had my CFA. I did the whole discounted cash flows looking at this thing. So it took me some time to get over the fact that these are not cash flow producing assets, and it's a different type. But is that one of the biggest concerns for new people entering into the world of alternatives?
Yeah, I think the challenge there is discerning what's garbage and what's quality, right? Because if it's not cash flowing, then you've got to figure out what the intrinsic value is. And a lot of stuff I think is garbage, right? And it won't be around in 3 or 4 or 5 years. And you've got to be able to pick out what matters, what has relevance, what people care about, and find those bits, because the greater fool theory is super relevant, super correct in a lot of cases. You see bubbles all over the place, like NBA Top Shot. If that was going way up into the right until it stopped, right, and people realize oh, actually we don't care about this very much. Or loads of NFT projects. How do you pick out the Bored Apes from the 3,000 other PFP projects launching in a given week. Same thing with the sports cards sort of hype last Jan, Feb, March. And you saw things that had no real right to be worth very much, like Garbage Pail Kids cards started to be worth mid 5 figures for like a nasty Nick Garbage Pail card, and like it was never worth that. But it's sort of like rode along the tailwinds, and discerning what is just greater fool from what's legit, it's hard and it's important. Unless your whole strategy is just to like ride greater fool theory from one thing to the next, which is, I guess, a legit thing to do as well.
Yeah, potentially it's a bit of the when the music's playing, you need to dance sort of thing, and make sure you can grab a chair, I suppose. Let's talk about.
It does highlight sort of like a problem, though. Sorry, just before we move on,
no,
it does highlight an issue that I didn't mention before, and I don't want to go into naming names and stuff, but you do see a lot in the space, whether it's crypto or NFTs or collectibles or things like that, where an influencer gets an audience and the pump and dump becomes real, and it can be horrible, right? Step 1, build up massive audience. Step 2, buy loads of X product. Step 3, say how awesome it is. Step 4, sell it to your audience. Step 5, take all your money and run. And you do see that, and it's not limited to crypto or NFTs. You see it in other asset classes as well. So it's hard to discern like what has organic enthusiasm sometimes from what is just like a few dudes who have banded together to pump and dump something. And I guess that's part of what I would go back to a minute ago when you said like if I can wave a magic wand to get rid of all the influencers who are doing the pumping and dumping. It's ultimately really negative for the entire industry.
Oh yeah, and there's some very well-known people that are doing that with NFTs and collectibles that come to mind instantly. So I definitely know what you're talking about there. But
yeah.
I the thing is, I put myself in those shoes, and that would be really, really, really hard to ignore, right? That you buy something for a few $1,000s, speak about it, on your show, and then suddenly that few $1,000s has a couple extra zeros on it. It takes a strong will to not be lured by that, I would imagine. You guys recently announced a fund, so the Alt One Fund, and I can link a lot of these things in the show notes, but let's talk a little bit about the investment thesis and kind of the allocations that you're looking at for this fund.
Yeah, for sure. So as we kind of said before, there's not a huge amount of institutional sort of investment opportunities in the space. So that's kind of one thing that we're looking to do is give institutions or people who want to invest on an institutional scale the ability to get in the space. And we're also trying to solve the discovery problem as well. So, there are 30 or 40 asset classes that are relatively like top tier. Within each one of those, there's thousands of different assets inside there, and figuring out what to invest in is tough. So we're looking to solve that problem as well. But generally speaking, like what we're looking to do is give people the opportunity to invest in a very broad basket of alts, relatively easy and risk minimized sort of way. So if you don't really know what you're doing, but you think that alts are cool, and you think that I've seen 40% annual returns for the last 10 years, I want a piece of that, then we're creating a way for folks to do that. And unfortunately, we're limited to accredited investors at the moment. We'll be launching a fund for non-accredited investors in the sort of reasonably near future. For anyone who doesn't know, accredited basically means you're rich, and non-accredited means you're not. So yeah, we're hoping to get broad access to it, and we're super excited. We've already started picking up assets. Our first one was a 1978 Kenner Star Wars Darth Vader action figure. A great example of things you wished you kept from your childhood. So there's we paid $25,000 for it. We value it at $30,000 plus. think it's going to have the potential to 5 or 10x in the next few years. Super bullish on the asset class in general. And yeah, the fund is all about stuff like that. We've got our allocation split up. We're looking at collectibles, crypto, NFTs, cultural stuff like historic items, fossils, meteorites, art, real estate, music, wine, spirits, sneakers, and books. And we're within each of those spaces. We've got an individual thesis for each one, and we're looking for the best opportunities to pick up assets that fit all that, ideally at a discount. And the fund is small enough that we can do that, right? If you're a $1 billion fund, you've got to allocate $200 million to asset class X. You're going to be overpaying and you're going to struggle. But if we're only $5 or $10 million, we can pretty easily allocate $300K into rare books, for example, without having to make too many compromises.
But that's a large hurdle for an institutional capital. It's like, how do you deploy $100 million into rare action figures? It's good luck. Well, yeah. It's good for you guys, because it kind of pumps the entire industry, I would imagine. But so a few things, like let's just double click on that action figure, for instance. One, I inherited all of these Star Wars action figures from my uncle who got them as originals. So I probably destroyed many of those rare, super expensive collectibles as a child, but damn it, I enjoyed the heck out of them. That's for sure. But so yeah, it's totally worth it. You get this action figure. The first thing that comes to mind, or the first two things that come to mind, is custodianship. Like, where do you custody something like this, and how do you do it? I would imagine it needs to be temperature controlled and in some safety deposit box, but which is not very scalable. And then secondly is exit strategy with something like this. So what sort of period of time are you looking to hold it for? Do you have a target price, or how do you think through that?
Yeah, so the custody stuff is one of those boring but really important factors you got to consider, and it's different for every asset class. So that's one of the main reasons we're not touching, for example, classic, even though they're a really popular alternative asset class and people love them. I don't want to deal with storing a 65 Mustang or whatever, right? I just don't have the mental, emotional, or physical bandwidth to deal with that kind of stuff. So we definitely factor in how we're going to store stuff and insure it. And the kind of one of the benefits of the sort of Cambrian explosion in this space has been that the picks and shovels industries have developed alongside it. So there are 3, 4, 5, 6 different vaulting services, basically, where you can send your 52 Mantle rookie card or 78 Kenner Darth Vader, and they'll store it and give you access to it when you want it. And they'll charge maybe a couple $100 a year, or a 1% fee, or things like that. And they're strategically located in sales tax free states, so you have to pay sales tax when you get it shipped there. So there's a whole little cottage industry around it, which is handy. Yeah, the exit it's a great question. And again, it depends a lot on the asset class itself. So, for example, if we're looking to invest in cask whiskey, which is, a distillery distills a bunch of whiskey, puts it in the giant barrels, which are called casks, but they want to age it for 30 years, then a lot of times they'll sell those casks straight away because they need the money, because they can't wait 30 years for the cash to come. So an investor like us comes and buys them. They appreciate 10 or 15% a year. And then, say 8 years down the line, we sell it to someone else who takes it from year, the last 22 years or whatever it is. And that's pretty straightforward. Things like the action figure we bought. So we're super bullish on the space. We don't think we'll be selling for the next couple of years at least. I think action figures have got 5x or 10x to run. So yeah, I'm not saying we wouldn't sell for any price, but we're going to be waiting quite a long time. When it does come time to sell, the best option is always going to be find a private buyer who kind of just happens to find you or through your network. Second best is some sort of a broker, and then increasing along the exponential fees curve. The last option is auctions. Broker will charge 10%, auction houses charge 20 to 40%. So you always want to try to find a private buyer if you can. But auction houses exist for a reason. They find the buyers for you.
Man, I had no idea those fees were that high. Yeah, private buyers. That's going to be extremely attractive. What with collectibles? I mean, this is an asset class that I've kind of seen come in with COVID and made me wish I kept all of my baseball cards and things like that. But what are some existential risks to that asset class overall?
I think the biggest risk is, you can think about collectibles the same way you think of fiat currency to some degree, right? It's worth something as long as everyone believes it's worth something. And the biggest risk with all these things is going to be people doing pumps and dumps, influencers trying to make a quick dollar, different folks colluding to scam people some way or another. And all of these in aggregate conspire to erode confidence in the industry. And that does create opportunities sometimes. So for example, with the video games I was mentioning a little while before, they got a 60%, 70% haircut in the months that followed those allegations coming out. And even if you think the prices were inflated with all the pumping and dumping allegedly was going on, taking a haircut of 2/3 is probably a pretty good buying opportunity. But the risk is it never comes back, right? People would say, oh yeah, video games, scams, don't want them. I don't see that happening on an industry-wide scale unless just like literally everything has its own scams or something like that. It's unlikely that what happened with video games will affect coin collecting, for example. So I get asked this question a lot when we have phone calls with investors for the fund, and people asking, what's the bear case? What would cause these things to go to zero? And I guess like the answer is people turn into robots and stop caring about nostalgia and stop caring about going to sports games and things like that. But I don't see that ever really happening. I can't think of a good everything goes to zero bear case for this stuff.
Well, I can, but it's more of a pitchforks and torches go to zero with a lot of other asset classes as well. Not many would do you much good in those situations. Are there any examples throughout, like looking back at history, Mark Twain, like history doesn't repeat, but it rhymes, but thinking about asset classes that, and, you don't have to talk about tulips. I think that one's been beat to death, but thinking about asset classes that were once a very, like the jewel of the time that are no longer, and we look back now and it was like, oh, that was such a silly thing for people to invest in. And is there anything throughout history that bumps into your mind that we could perhaps learn about and apply towards some of these investment trends that are happening today?
Yeah, I think there's a great example of that. And it goes back to what you were saying a minute ago about like wishing you kept all your baseball cards and stuff. So in the late 80s, early 90s was the junk wax era for sports cards, which is, baseball cards got really popular. Topps, Donruss, Fleer, all of them saw that popularity and then printed 300 times more cards than they probably should have. And because of that, everything, even today, everything from that era is basically worthless. There's just so much of it, like not worth the paper it was written on. And I see parallels to modern cards today, not necessarily so much being printed, but more with how much stuff is getting what's called slabbed. And slab means you send it off to the grading authority to say this is a 1, 2, 3, 4, 5 up to 10 card, and they put it in a bit of plastic covering. And people are calling that are we in the junk slabbing era, which is people started liking sports cards again and during COVID and a little bit before. The most valuable versions of those are things that have been graded and authenticated. And now everyone's sending everything off to be graded and authentic. And we've seen a bit of it already, but you see, rookie cards for, prominent basketball players or baseball players or whoever it is, and there's like 15 or 20,000 of these that have been sent off to PSA or BGS and have got perfect scores, and it's not worth anything anymore. It's not the same thing as a 52 Mantle or a 1980 scoring leaders Irving and Bird and Johnson card. Like, the scarcity nowadays is artificial. Like, everyone's got the perfect version of it. So I think we're going to see a similar glut in the future with sports cards, today's sports cards, to what we had in the 90s. And you do see that asset classes kind of rhyme over time. You can pick up on what makes asset class A work and then apply it to asset class B. And you can see the trends, and you can see the patterns. And, it's part of why running a fund of 30 odd asset classes isn't quite as overwhelming as it sounds at first sort of blush, because there are so many similarities between them. And you can spot the sentiment. You can spot when something is running out of steam, or when it's picking up steam, or whatever it is. And usually the main factor of anything going into a bear market or whatever it is, it's somehow associated with greed, whether it's pumping and dumping or collusion, or sports cards companies making too much of whatever they've got. It's when someone spots an opportunity to make money, they exploit it, and that kind of ruins it for everyone.
I'm just thinking, listening to this, what do you think about NFTs just eating into the collectibles market? I mean, I started thinking like Bitcoin, which is, air quote, digital gold, eating into the gold market. Or even me personally, I lived out of a carry-on suitcase for 4 years. I loved collectibles and culture, but like digital works better for me. It's the same reason why I travel with my Kindle. I have 100 books as opposed to lugging around a bunch of physical books. So how do you see NFTs interacting with the collectibles market overall, and this idea of digital, provably scarce digital collectibles versus?
Yeah, I think so. Part of it is we're in a rising tide lifts all boats sort of scenario now, where the more stuff like this that we have out there, the more legitimate it gets, the more money flows in. So the pie keeps getting bigger, so it doesn't matter as much like how big each individual slice is. I think it's also a slightly generational thing. So people who live their lives online, people who think there will be a metaverse that comprises a significant amount of our day-to-day routines in the near future, they're more likely to be on the NFT side of things. Whereas people maybe a bit older in the Woodstock era, that kind of stuff, they're going to be more into physical. So I think there definitely is the opportunity for them to sort of be zero sum to some degree, but I don't think it's huge. And you do see a bit of crossover as well. So, Dibs is a mostly sports card fractional marketplace, and what they've done is create NFTs for all the assets, broken them up into shards, and then people could buy an NFT that gives them a share of a physical asset. So you do see blending happening a bit like that. And then there are other sort of more creative ways as well, or I don't know, maybe less creative. But yeah, I was mentioning the vaults before about where people store their sports cards and Darth Vaders and all the rest of it. And you can buy a card now on eBay and then have it sent directly to their vault, where you don't ever have to deal with shipping or receiving or taking ownership or anything of the actual item. So if you don't care about having the physical thing in your hand, you don't need to deal with it. And for investing, for example, that makes it a lot easier. You don't need to deal with all that stuff. You can just move bits across from your account to someone else's account and then move them back when you want to sell it. So I don't necessarily think it's an either or, but there's a lot of opportunities in the both space as well.
Yeah, that makes sense. And a lot of these asset classes will continue to converge and kind of evolve into something closer to each other. What is so you have this rare eagle-eyed view of all of these different alternative investments. So let's start off with the most bullish alternative asset segment for the next 5 years in your eyes.
Well, it's in the things that people haven't discovered yet, and that's what we're obviously focusing on with our fund. Finding the next, right? And again, that's where having the 20,000 foot view and seeing what happens in one asset class and applying it to the next one. So I'm super bullish, for example, on the music industry, not necessarily like royalties and NFTs and stuff, but in vintage vinyl, vintage concert posters, that kind of stuff. It pulls on all the same strings that sports cards or anything like that pulls on, but it's just not been looked at so much yet. And I think there's actually a strong case that people of the Woodstocky sort of generation will care a heck of a lot more about that, and as they get older, reliving their youth a bit, and I can get this poster from 66 Grateful Dead at the Avalon Ballroom, and I was there. I remember it. That's worth a lot to me. Like, I'm a rich guy now, so we're super bullish on those spaces. I mentioned before, loving the collectible toys like action figure space as well. I'm really bullish there. Whiskey has a lot to offer still, but even maybe more is like, what's the next whiskey? So we're looking at in that space. So, a lot of it is taking what's popular now and what's popular the last 2 or 3 years and being able to figure out what's next. And that's where like all of our data analysis comes in, and all the sort of on the ground scraping of auction catalogs and all the rest of it. It's going to help.
Yeah, good answer. And then what about the most overhyped alternative asset segment right now?
Overhyped. Depends how alternative you want to get. Like, I'm mega worried for U.S. residential market. For example, that's not very alternative, but there are a lot of leading indicators that there's going to be a bit of a bubble popping there potentially. But on the more alt side of things, ticket stubs have become a big thing in the last 4, 5, 6 months, and it's one of those things that hasn't grown. The enthusiasm hasn't grown organically. It's grown because it feels like a few people have decided they're a big thing, so they're making it a big thing, and it's being pushed as like the best of both worlds between sports cards and memorabilia. It looks like a sports card, but it's got all the game authenticity of a signed jersey or something like that. And it's one of those things where if you do this long enough, you can feel when something feels a bit off, and that just feels a bit off to me.
Man, ticket stubs. I had no idea. I worked from my parents' house last year sometime, and the office where I was set up, it had my dad's, all of his ticket stubs from his childhood, along with like vinyl records up on the wall. And there was a certain age category of people that would see that background and just go bananas. So I think he's got a gold mine behind that office down there. That's for sure.
That's the thing with tickets. They're like, so much of the value of a ticket stub is your memory of being at that event, right? It's much more about it. It reminds you of being there in a way that is unique to that asset class, and I don't think translates well to selling to somebody else. It's like if Babe Ruth signed, maybe not Babe Ruth, like say Mike Trout signed a baseball to you and said like, to Ben, you're awesome, love Mike Trout. Like, that's worth so much more to you than it would be to me. I think ticket stubs are kind of the same way.
Yeah, I agree. I mean, it makes me think in the crypto space of POAPs, right? It's a bit of a solution looking for a problem, maybe, but it's essentially a proof of attendance, a ticket stub, but provable on the blockchain that you were there at that point.
Yep.
It's pretty cool that that could be like in 10 years, the next like massive bubble. Let's talk briefly on US residential real estate. I've seen you write about this before, but I'm out in California right now, and people are buying things at $2,000 a square foot, and I've been unsuccessfully buying real estate in Portugal for some time now at $100 to $300 a square foot, a tenth of the price. Talk about some of the leading indicators or kind of reasons why the U.S. residential real estate market scares you.
Yeah, and this is so I lived through 2008. I had the misfortune of going to business school from 2007, 2009. So I graduated in like the worst in the history of graduating from business school. So
I graduated in 2009 with finance too, but from undergrad. Yeah, not good.
Yeah. So like laying my biases out there, out on the table there. But yeah, you see things like, so interest rates are coming up. They have to come up to combat. You're seeing it already happen with 30-year mortgages. You're looking at the mortgage divided by rent ratios in a lot of markets, and they're just they're as high as they've been since 2007, sort of thing. You're reading and hearing all the same kind of things that I was reading and hearing when I was trying to buy a house in Washington, D.C. in 2006, 2007, which is, we have an open house, 20 people signed up, sold by the end of the day with 15 competing offers. Like it's all the same stuff. And in the same way that I can recognize, I feel like ticket stubs are a bad idea. You hear enough, you experience enough, and your spidey sense tells you something isn't quite right here. This can't sustain itself. People just literally can't afford it. Inflation's going up, wages are not going up to keep pace. Mortgages are going up relatively because of interest rates, but they're also going up absolutely because the housing prices are so much higher relative to what rent is. And something has got to give. Like I don't think there's a mortgage-backed like derivative situation in the background somewhere. It's just much more structural and fundamental that like this, something's got to give, and people can't afford this stuff.
Yeah, I agree. It is crazy. Well, Wyatt, it was great having you on today, being aware of time here. So where can people find out more about you or alts, or where would you like to send them?
Yeah, go to alts.co, sign up for the newsletters, have a look at the fund prospectus. It's there to download if you think that, if I sound smart and you like what we're doing. I'm on Twitter a little bit as well. It's mostly just shit posting, but feel free to give me a follow. It is Wyatt. I'm around. I love hearing from folks. I'm always looking for new ideas.
Really appreciate it, Wyatt.
There you go. First off, thank you very much for listening all the way through. I hope you got a lot of value out of that conversation. As always, you can find show notes, links, and more at altassetallocation.com. Please share this with anyone you think might be interested and derive any value from this conversation. And as always, you can reach out to me for any feedback or questions. Please give the video a like, or even better, subscribe on YouTube or your podcast player of choice. This really helps others find the podcast or the video as well. Thanks a lot. Hope everybody has a fantastic day, and stay safe out there and invest wisely. Cheers. 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 Cheers.